Mohamed, I wonder if the faith in the policymakers' ability to stabilise things finally got a test yesterday.
It did, and it was a reminder of two things. One is that the ECB gave up its policy optionality way too early, something that you and I discussed 4 and 5 months ago. And two, that the ECB fell victim, if you like, to a cyclical head fake. It believed that the bounce a year ago, 9 months ago, was structural in nature. It turned out to be cyclical in nature.
So, Mohamed, when I look at the market response to all of this, if I look at a chart of euro-dollar yesterday as it gapped lower, if I look at a chart of the 10-year bund yield as it plunged ever lower, what percentage of that do you think was off the back of the policies that the ECB announced? And what percentage of that do you think was just off the back of those policies and the belief that no one thinks they'll work?
I think it was a combination of both. And look at what happened to the banks. What basically the market is telling you is liquidity support may be necessary, but it's not sufficient. So every reaction was a combination of the liquidity support and a combination of fears about growth outlook. And you see that most markedly in what happened in the fixed income space. And you see it also in what happened to bank stocks.
So, Mohamed, going forward, we've seen this before. We had the growth scare of 2015, 2016. Through 2018 into 19, we've had this V-shaped recovery. A lot of people had a lot of faith in the policymakers' ability to stabilise the situation. If this is that moment where we have that faith tested, what's your advice to people about how they manage it? Is it the playbook of 15, 16, or is this different?
Well, first of all, listen to what Draghi said. He spent a very long time, both in his statement and his answers, lecturing other policymakers in Europe to get their act together. And he was basically telling us, I'm going to try to do what I can, but I cannot deliver growth. And that was really important. So the first thing is the reality of the politics is such that you will not get pro-growth policies, and Europe is going to end up with sub 1% growth rate, which means a high risk of stall speed. And bad things happen at stall speed. The second takeaway, I think, is divergent growth. That is our reality. Notwithstanding today's labor report, the U.S. will continue to outpace other advanced economies, and there's a ton of trades that can be made on the basis of the divergent growth thesis that do not expose you to too much risk.